Well, banking regulator APRA has cracked down on risky home loans by making it more difficult for Australians to borrow larger sums of money. For more, I'm joined by our business reporter, Ed Boyd. Ed, APRA says the changes are not in response to skyrocketing house prices.
Kind of funny, house prices are up 20% across Australia's capital cities over the last 12 months. And people have been wondering, what is the government or what are regulators going to do to put curbs on property prices? Well, APRA today have come out with some new regulations for banks. They say it's not about property prices, it's about reducing risks in the mortgage system. So these are the new changes on the screen here. Effectively, they are making the home loan rate buffer increased from 2.5% up to 3%. So if someone has a home loan that's 3%, if they want to get a home loan from a bank, they will need to be able to pay it off at a 6% rate. That's the new accessibility rate. So as an example, say someone has a home loan worth $500,000, it's at a mortgage rate of 3.19%. That's at the moment, that's about $2,160 a month in repayments. But under these new guidelines, you will need to be able to pay that loan off at the rate of 6.19%. $3,060 a month, so $900 more each month in repayments. So APRA Chair Wayne Byers says in taking this action, APRA's focused on ensuring the financial system remains safe and that banks are lending to borrowers who can afford the level of debt they are taking on, both today and into the future. And APRA say the changes are going to reduce an average borrower's maximum borrowing amount by about 5%. So it's to put a little bit of the brakes on the property market here.
OK, well, we'll see how that works out, but certainly it is making it difficult for people to get loans, bigger loans at least. But as you say, it might just affect investors and then eventually might see effect on the housing market, but all this to play out. But first, before we see that, let's look more immediately at the markets. Investors are nervously waiting once again for an update from Chinese developer Evergrande.
Evergrande shares went into a trading halt on Monday pending an announcement from the company, and they're yet to come out of a trading halt. On the screen here, you can see this is Evergrande's electric vehicle factory. They're such a large business, they decided in 2018 they were going to compete with Tesla and build electric cars for China. This is their factory here. They've spent billions of dollars on this, but they're yet to sell a single electric vehicle, and they've racked up losses of about $740 million for just this car unit alone. But the speculation is, here's some of Evergrande's outstanding debt payments that are due between now and the end of the year, totalling almost $600 million. So they've got a lot of debt to go. The shares are in a trading halt where they're trying to reach some sort of deal to sell off some of their subsidiary businesses to raise roughly $5 billion. But they've been in a trading halt since Monday, and this problem with Evergrande, with property prices in China falling, is affecting other businesses in the Chinese property market as well. And another company called Cynic Holdings, its shares have been in a trading halt since the 20th of September. I think we've got a share price chart here. You can see its shares plummeted almost 90% in one day. And since then, they've been in a trading halt pending an announcement from the company. So their shares have been in a trading halt for almost 2.5 weeks. Evergrande's have been in a trading halt for 3 days. Hopefully, both of these companies can come out with an announcement to the market on some sort of debt restructuring program, because it's giving the market the jitters. Our market today it's up by just 0.1%. But it could fall significantly if there's no deal with Evergrande over the next week.
OK, Ed, thanks so much. That graphic would certainly be very concerning for investors and anyone watching the market. We'll check in with Ed soon.